Question 1. Risk management concepts. Which of the following statements best describes the principle of indemnity in insurance? A. Indemnity allows an insured party to profit from a loss. B. Indemnity restores the insured to the same financial position as before the loss. C. Indemnity requires the insured to pay a higher premium for lower deductibles. D. Indemnity mandates that the insurer must pay only a portion of the total loss. Answer: B. Indemnity restores the insured to the same financial position as before the loss. Explanation: the principle of indemnity is a fundamental concept in insurance that ensures that the insured does not profit from a loss but is instead restored to their original financial position. This principle aims to prevent moral hazard, where an insured might take excessive risks if they knew they could profit from a claim. According to the Ohio Revised Code ORC 3937.1, the indemnity principle emphasizes that an insurance contract is meant to provide compensation for actual losses incurred, maintaining a balance between the insured's risk and the insurer's payout. Therefore, options A, C, and D misinterpret the purpose of indemnity, which is solely focused on loss restoration without profit. Question 2. Property insurance policy types. Which of the following statements is true regarding the special form HO3 homeowners insurance policy? A. The HO3 policy provides open perils coverage for both the dwelling and personal property. B. The HO3 policy covers only named perils for the dwelling but open perils for personal property. C. The HO3 policy provides named perils coverage for both the dwelling and personal property. D. The HO3 policy covers open perils for the dwelling and named perils for personal property. Answer: D. The HO3 policy covers open perils for the dwelling and named perils for personal property. Explanation: the HO3 policy is one of the most common types of homeowners insurance. It provides open perils coverage, also known as all-risk coverage, for the dwelling, meaning that it covers all causes of loss except for those specifically excluded in the policy. However, it provides named perils coverage for personal property, meaning that only the perils listed in the policy are covered. This distinction is crucial for homeowners to understand to ensure adequate protection. The Ohio Department of Insurance regulates these policy types under ORC 3937.10, which mandates that homeowners receive clear disclosures regarding their coverage. Question 3. Scenario-based question on claims management. Mr. Thompson recently had a fire in his restaurant which caused significant damage to both the building and equipment. He has an active commercial property insurance policy underwritten by a local insurer. After reporting the loss, the insurance adjuster informs Mr. Thompson that they will need to conduct an investigation to determine the cause of the fire. What should Mr. Thompson do to ensure that his claim is processed efficiently? A. Delay providing any additional information until the adjuster requests it. B. Gather all documentation related to the loss, including receipts, photographs, and any maintenance records, and provide this to the adjuster promptly. C. Discuss the details of the claim with employees to get their opinions before speaking with the adjuster. D. Assume that the adjuster will find all relevant information without his assistance. Answer: B. Gather all documentation related to the loss, including receipts, photographs, and any maintenance records, and provide this to the adjuster promptly. Explanation: in the claims process, particularly following significant losses like fire damage, it is critical for the insured to actively participate and assist in the claims investigation. Mr. Thompson should gather all relevant documentation such as receipts for the damaged equipment, photographs of the fire damage, and records of any maintenance performed on the building. This documentation can help substantiate his claim and facilitate a quicker settlement. According to the Ohio Department of Insurance guidelines, policyholders are encouraged to cooperate fully with adjusters as outlined in ORC 3937.5, which emphasizes the importance of providing timely information to expedite claims processing. Options A, C, and D could lead to delays or complications in the claims resolution process, which can adversely affect the outcome for the insured. Question 4. Casualty insurance liability coverage. Which of the following statements accurately describes general liability insurance? A. It only covers damages to property owned by the insured. B. It covers bodily injury and property damage liability arising from the insured's operations. C. It excludes coverage for claims arising from employee injuries. D. It provides coverage for personal and advertising injury only. Answer: B. It covers bodily injury and property damage liability arising from the insured's operations. Explanation: General liability insurance is designed to protect businesses from financial loss due to third-party claims for bodily injury and property damage arising from their operations. This type of coverage is essential for businesses as it can cover legal fees, settlements, and judgments, according to the National Association of Insurance Commissioners, NAI. This coverage is fundamental to protecting against claims that occur on the business premises or result from the business's operations. Options A and C misinterpret the coverage scope, while option D refers specifically to personal and advertising injury coverage, which is only one aspect of general liability insurance. Question 5. Life insurance policy features. Which of the following best describes the concept of a beneficiary in a life insurance policy? A. The beneficiary is the person who pays the premiums for the policy. B. The beneficiary is the individual who receives the death benefit upon the policyholder's death. C. The beneficiary is the insurance company and underwrites the policy. D. The beneficiary is the insured individual whose life is covered by the policy. Answer. B. The beneficiary is the individual who receives the death benefit upon the policyholder's death. Explanation. In life insurance, a beneficiary is the person or entity designated to receive the death benefit when the policyholder passes away. This designation is a critical aspect of life insurance planning, ensuring that the financial interests of the policyholder are protected after their death. The Ohio Department of Insurance requires clear beneficiary designations in policy documentation to avoid disputes. Option A confuses the role of the beneficiary with that of the policyholder, while options C and D misrepresent the definitions altogether. Question 6. Health insurance policy provisions. Which of the following statements regarding coinsurance in health insurance is accurate? A. Coinsurance is a fixed amount paid by the insured for each service rendered. B. Coinsurance is the percentage of costs that the insured pays after the deductible is met. C. Coinsurance refers to the total amount the insurer will cover for a specific treatment. D. Coinsurance is applicable only in preferred provider organizations, PPOS. Answer. B. Coinsurance is the percentage of costs that the insured pays after the deductible is met. Explanation. Coinsurance is a cost-sharing arrangement in health insurance where the insured pays a certain percentage of the medical expenses after the deductible has been met. For example, if a policy has a 20% coinsurance requirement, the insured would pay 20% of the covered medical expenses, while the insurer pays the remaining 80%. This arrangement encourages policyholders to use health services judiciously. Ohio regulations mandate clear disclosure of coinsurance terms in health policies, ensuring policyholders understand their financial responsibilities. Options A, C, and D misrepresent the nature of coinsurance and its application in various insurance models. Question 7. Insurance marketing ethics. Which of the following actions would be considered a violation of ethical standards in insurance marketing? A. Providing accurate information about policy benefits to potential clients. B. Exaggerating the benefits of a policy to close a sale. C. Disclosing all fees and commissions associated with a policy upfront. D. Offering free consultations to discuss clients' insurance needs. Answer. B. Exaggerating the benefits of a policy to close a sale. Explanation. Exaggerating policy benefits to secure a sale constitutes misrepresentation and is a serious violation of ethical standards in the insurance industry. According to the Ohio Department of Insurance and the NAICS guidelines on ethical conduct, agents must present truthful and accurate information about the products they sell. Misleading clients can lead to regulatory action and loss of license. Options A, C, and D reflect ethical behavior, emphasizing the importance of transparency and honesty in client interactions. Question 8. Current trends in insurance. Which of the following is considered a significant emerging risk that insurers must account for in their underwriting processes? A. Increased use of traditional marketing strategies. B. Rise in natural disasters due to climate change. C. Decreased prevalence of cyber attacks. D. Increased regulatory burdens on traditional insurance models. Answer. B. Rise in natural disasters due to climate change. Explanation. Climate change has led to a significant increase in the frequency and severity of natural disasters, which presents emerging risks for insurers. This shift necessitates a reevaluation of underwriting practices, as traditional risk assessment models may not adequately account for these new realities. Insurers in Ohio and beyond must incorporate these factors into their pricing, coverage options, and risk management strategies to remain viable. Options A, C, and D do not reflect emerging risks, with C particularly misrepresenting the reality of rising cyber threats rather than A decrease. Question 9. Claims dispute resolution. In the context of claims management, which of the following practices is essential for fraud detection and prevention? A. Limiting communication with claimants to reduce confusion. B. Conducting thorough investigations into claims that seem unusual. C. Processing claims as quickly as possible without extensive review. D. Requiring policyholders to provide a sworn statement of loss before initiating an investigation. Answer: B. Conducting thorough investigations into claims that seem unusual. Explanation: to effectively detect and prevent insurance fraud, insurers must conduct comprehensive investigations into claims that appear suspicious or unusual. This approach aligns with the ethical standards set by the Ohio Department of Insurance, emphasizing the need for vigilance in claims handling. Thorough investigations can involve verifying details, collecting evidence, and even conducting interviews. Options A and C could lead to oversights in identifying fraudulent claims, while D places unnecessary burden on policyholders without enhancing fraud detection. Question 10. Principles of insurance. Which of the following is an essential principle of insurance that underpins all insurance contracts? A. The principle of competition. B. The principle of adverse selection. C. The principle of subrogation. D. The principle of risk transfer. Answer: D. The principle of risk transfer. Explanation: the principle of risk transfer is fundamental to insurance as it allows individuals or businesses to transfer the financial risk of potential losses to an insurer in exchange for premium payments. This principle enables the insured to manage uncertainties effectively, knowing that they are protected against significant financial burdens. Under Ohio insurance regulations, this principle is crucial for understanding how insurance contracts function. Options A and B do not represent fundamental principles of insurance, while option C refers specifically to the insurer's right to recover costs from a third party after paying a claim, which, while important, is not foundational to all insurance contracts. Question 11. Indemnity principle. Which of the following statements accurately describes the principle of indemnity in insurance? A. It allows the insured to profit from a loss by collecting more than the actual loss incurred. B. It ensures that the insured is restored to the same financial position they were in prior to the loss. C. It prevents insurance companies from paying claims that exceed the policy limits. D. It requires insurers to disclose all underwriting criteria to the insured. Answer: B. It ensures that the insured is restored to the same financial position they were in prior to the loss. Explanation: the principle of indemnity is fundamental in insurance, aimed at preventing the insured from profiting from a loss. Instead, it seeks to restore the insured to their pre-loss financial condition, ensuring that they do not receive more than the actual loss incurred. This principle is crucial in maintaining fairness and integrity in the insurance process. Under Ohio insurance regulations, adherence to this principle is mandatory in claims processing. Options A and D misinterpret the essence of indemnity, while option C relates to policy limits rather than the core principle itself. Question 12. Property insurance exclusions. Which of the following is commonly considered an exclusion in a standard homeowner's insurance policy? A. Damage caused by fire. B. Theft of personal property. C. Water damage from flooding. D. Damage from falling objects. Answer: C. Water damage from flooding. Explanation: in a standard homeowner's insurance policy, water damage resulting from flooding is typically excluded. Homeowners must often purchase separate flood insurance to cover this risk. This exclusion is in line with the National Flood Insurance Program and FIP guidelines, which aim to mitigate the financial impact of flood-related losses. Options A and B generally fall under covered perils, while option D can vary by policy but is not as commonly excluded as flooding. Question 13. Professional liability insurance. What is the primary purpose of professional liability insurance? A. To cover damages related to property damage. B. To protect professionals against claims of negligence or malpractice. C. To provide coverage for bodily injury in a workplace accident. D. To cover the costs of marketing and advertising. Answer: B. To protect professionals against claims of negligence or malpractice. Explanation: professional liability insurance, often referred to as errors and omissions (EO) insurance, is specifically designed to protect professionals against claims of negligence, errors, or omissions in the services they provide. This type of insurance is crucial for professionals such as doctors, lawyers, and accountants, as it covers legal fees, settlements, and judgments associated with malpractice claims. Options A and C pertain to general liability coverage, while option D is not relevant to professional liability insurance. Question 14. Risk management techniques. Which of the following strategies is considered an effective risk control measure? A. Purchasing additional insurance coverage. B. Ignoring low probability, high impact risks. C. Implementing safety training programs for employees. D. Increasing deductibles on insurance policies. Answer C. Implementing safety training programs for employees. Explanation. Implementing safety training programs is an effective risk control measure as it helps to reduce the likelihood of accidents and losses by educating employees about safety protocols and best practices. This proactive approach is essential for minimizing risks within an organization. In contrast, option A is a risk transfer mechanism. Option B reflects poor risk management practices, and option D increases the insured's financial exposure rather than controlling risk. Question 15. Ohio Department of Insurance Regulations. Which of the following statements accurately reflects the role of the Ohio Department of Insurance? A. It exclusively approves insurance claims for policyholders. B. It regulates the insurance market and enforces compliance with state laws. C. It only oversees life insurance policies and excludes other types of insurance. D. It sets the premiums for all insurance policies sold in Ohio. Answer. B. It regulates the insurance market and enforces compliance with state laws. Explanation. The Ohio Department of Insurance plays a crucial role in regulating the insurance industry within the state, ensuring that insurance companies comply with state laws and protecting consumer interests. This includes overseeing licensing, approving rates, and enforcing regulations that govern various types of insurance products. Options A and D misrepresent the department's responsibilities, while option C incorrectly narrows its oversight to only life insurance. Question 16. Auto insurance requirements. Which of the following is a mandatory requirement for auto insurance in Ohio? A. Comprehensive coverage. B. Liability coverage for bodily injury and property damage. C. Personal injury protection (PIP). D. Collision coverage. Answer. B. The liability coverage for bodily injury and property damage. Explanation. In Ohio, all drivers must carry liability insurance, which covers bodily injury and property damage resulting from accidents they cause. This is in accordance with Ohio's financial responsibility laws, which aim to protect victims of automobile accidents. Options A, C, and D may be beneficial but are not required by law, making B the correct answer. Question 17. Coverage extensions in insurance policies. What does the term coverage extension typically refer to in an insurance policy? A. Additional coverage options available for purchase. B. Increased policy limits without additional premiums. C. Coverage for newly acquired property for a limited time. D. Complete exclusion of specific perils from the policy. Answer. C. Coverage for newly acquired property for a limited time. Explanation. Coverage extensions in insurance policies often provide temporary coverage for newly acquired property, such as personal belongings or additions to a home, for a limited time. This ensures that policyholders are protected while they formally report and insure the new items. This provision is commonly found in homeowners and personal property insurance policies. Options A and B describe options that may or may not be part of a standard policy, while option D pertains to exclusions, not extensions. Question 18. Underwriting considerations. In underwriting health insurance policies, which of the following factors is most critical in determining insurability? A. The age of the applicant. B. The applicant's credit history. C. The geographic location of the applicant. D. The applicant's occupation. Answer A. The age of the applicant. Explanation. In health insurance underwriting, the applicant's age is a significant factor in assessing risk, as older individuals generally have a higher likelihood of health issues and thus incur higher medical costs. This age-related risk is factored into premium calculations and coverage decisions. While options B, C, and D can influence underwriting decisions, they are typically not as critical as age in the context of health insurance. Question 19. Insurable interest. Which of the following statements accurately reflects the concept of insurable interest? A. It refers to the relationship between the insured and the insurer. B. It must exist at the time of application for an insurance policy. C. It is irrelevant for life insurance policies. D. It allows the insured to profit from an insurance claim. Answer. B. It must exist at the time of application for an insurance policy. Explanation: insurable interest is a fundamental concept in insurance that requires the insured to have a legitimate financial interest in the property or life insured at the time of applying for coverage. This principle prevents moral hazard and ensures that insurance is used as a risk management tool rather than a speculative investment. In Ohio, this requirement is critical for the validity of the insurance contract. Options A and D misrepresent the concept, while option C inaccurately states that insurable interest is irrelevant for life insurance. Question 20. Claims process overview. What is the primary purpose of the claims process in insurance? A. To determine the amount of the insurance premiums. B. To assess the risk profile of the insured. C. To facilitate the payment of covered losses to the insured. D. To review the marketing strategies of the insurance company. Answer: C. To facilitate the payment of covered losses to the insured. Explanation: the claims process is designed to ensure that insured parties receive payment for covered losses in a timely and efficient manner. This process involves reporting claims, investigating the circumstances of the loss, and determining coverage eligibility. Adherence to the claims process is essential for maintaining trust and integrity in the insurance industry, particularly in compliance with Ohio's Fair Claims Practices regulations. Options A, B, and D misrepresent the purpose of the claims process. Question 21. Exemptions to liability coverage. Which of the following scenarios would most likely be excluded under a standard general liability insurance policy? A. An employee slips and falls on a wet floor in the office. B. A contractor accidentally damages a client's property while working. C. A business owner is sued for slander after a negative review. D. A fire breaks out in the warehouse, damaging the inventory. Answer: C. A business owner is sued for slander after a negative review. Explanation: while general liability insurance typically covers bodily injury and property damage, it often excludes coverage for personal injury claims like slander, libel, or defamation. These claims are typically covered under a separate type of insurance known as personal injury coverage or professional liability insurance. Options A and B are generally covered by general liability insurance, and D is also typically covered unless exclusions apply. Question 22. Key components of insurance contracts. What are the essential elements required for a legally binding insurance contract? A. Offer, acceptance, consideration, and legal capacity. B. Negotiation, underwriting, coverage limits and exclusions. C. Premium payment, coverage period, terms of renewal and cancellation. D. Claims process, deductible, policy limits, and endorsements. Answer A. Offer, acceptance, consideration, and legal capacity. Explanation: for an insurance contract to be legally binding, it must include the following elements: an offer made by one party, acceptance by the other, consideration, usually in the form of premium payments, and the legal capacity of both parties to enter into the contract. These elements ensure the validity of the contract. Options B, C, and D pertain to aspects of the insurance process but do not capture the fundamental elements necessary for a binding contract. Question 23. Homeowners insurance coverage. Which of the following losses is typically covered by a standard homeowners insurance policy? A. Damage from a flood. B. Theft of personal property. C. Earthquake damage. D. Wear and tear on appliances. Answer B. Theft of personal property. Explanation: a standard homeowners insurance policy generally covers theft of personal property, providing protection against losses due to burglary. However, flood damage is usually excluded and requires separate flood insurance. Earthquake damage often requires additional coverage or endorsements, and wear and tear is considered a maintenance issue and is not covered. Question 24. Business interruption insurance. What is the primary purpose of business interruption insurance? A. To cover employees' salaries during a natural disaster. B. To protect against losses resulting from property damage. C. To compensate for lost income during a business shutdown due to a covered peril. D. To provide liability coverage for accidents occurring on business premises. Answer C. To compensate for lost income during a business shutdown due to a covered peril. Explanation: business interruption insurance is designed to cover the loss of income that a business experiences during a period of disruption caused by a covered peril, such as a fire or natural disaster. This type of coverage is crucial for helping businesses maintain cash flow while they recover from physical damage. Options A and B may be components of broader policies, while option D relates to general liability rather than interruption coverage. Question 25. The role of an insurance adjuster. What is the primary function of an insurance adjuster? A. To determine the amount of premium the insured must pay. B. To evaluate claims and determine the insurer's liability. C. To sell insurance policies to prospective clients. D. To provide legal advice regarding insurance disputes. Answer: B. To evaluate claims and determine the insurer's liability. Explanation: the main role of an insurance adjuster is to assess claims submitted by policyholders and determine the validity and amount of the insurer's liability. This involves investigating the circumstances of the loss, reviewing policy coverage, and making recommendations for payment. Adjusters do not set premiums. A. Sell policies. C. Or provide legal advice. D. Question 26. Replacement cost versus actual cash value. Which of the following best describes the difference between replacement cost and actual cash value (SCV) in property insurance? A. Replacement cost covers the cost of repairs, while SCV is the initial purchase price. B. Replacement cost is based on the current market value, while a CV considers depreciation. C. Replacement cost is the amount needed to replace an item without deducting depreciation, while a CV deducts depreciation from the replacement cost. D. Replacement cost is only applicable to new items, while a CV applies to all items regardless of age. Answer: C. Replacement cost is the amount needed to replace an item without deducting depreciation, while a CV deducts depreciation from the replacement cost. Explanation: replacement cost refers to the amount needed to replace an asset with a similar one without considering depreciation, ensuring that the insured can replace the item with a new equivalent. In contrast, actual cash value (SCV) takes depreciation into account, meaning it compensates the insured based on the item's current market value. This distinction is critical in determining how claims will be paid out under property insurance policies. Question 27. Underwriting guidelines. Which of the following factors is least likely to be considered by underwriters when evaluating a life insurance application? A. The applicant's medical history. B. The applicant's lifestyle choices, such as smoking. C. The applicant's personal financial situation. D. The applicant's favorite recreational activities. Answer: D. The applicant's favorite recreational activities. Explanation: underwriters focus on factors that directly impact the applicant's risk profile, such as medical history. A. Lifestyle choices. B. And financial situation. C. As these can influence life expectancy and insurance risk. While certain recreational activities may be relevant, for example extreme sports, the general question about favorite activities is less likely to affect underwriting decisions. Making option D the least likely factor considered. Question 28. Types of liability insurance. What type of liability insurance specifically covers claims arising from professional services provided by individuals such as doctors, lawyers, or accountants? A. General liability insurance. B. Product liability insurance. C. Professional liability insurance. D. Directors and officers liability insurance. Answer: C. Professional liability insurance. Explanation: professional liability insurance, also known as errors and omissions (EO) insurance, is designed to protect professionals from claims arising out of the services they provide. This includes coverage for allegations of negligence, errors, or omissions in their professional duties. General liability insurance: A. Covers general business liabilities. Product liability. B. Covers claims related to products sold, and directors and officers liability. D. Pertains to claims against company executives. Question 29. Fair claims practices. Under Ohio law, what is the primary objective of fair claims practices regulations? A. To reduce the overall number of claims filed by policyholders. B. To ensure timely and equitable resolution of claims. C. To prevent insurance companies from charging high premiums. D. To encourage policyholders to purchase additional coverage. Answer: B. To ensure timely and equitable resolution of claims. Explanation: fair claims practices regulations are designed to protect consumers by requiring insurance companies to handle claims promptly, fairly, and transparently. These regulations aim to maintain trust in the insurance system by ensuring that policyholders receive fair treatment when they file claims. Options A and C misinterpret the purpose of these regulations, while D is not a relevant objective of fair claims practices. Question 30. Insurance fraud. Which of the following actions would likely be classified as insurance fraud? A. Failing to report a minor fender bender to your auto insurer. B. Submitting a claim for damage that was intentionally caused. C. Requesting a higher coverage limit than previously held. D. Delaying a claim submission due to confusion over coverage. Answer: B. Submitting a claim for damage that was intentionally caused. Explanation: insurance fraud involves acts intended to deceive an insurer for financial gain. Submitting a claim for damage that one has intentionally caused constitutes fraud because it misrepresents the circumstances of the loss to secure an illegitimate payout. Options A, C, and D do not inherently involve deception aimed at defrauding the insurer and would not typically be classified as fraud.